from the morning reading. Good morning, traders. Liftoff from an FOMC non-rate hike was an epic fail yesterday, which does not bode well for stocks in the near term. The anticipation by traders of a breakout manifested in 4 higher S&P 500 index closes in the 5 trading days leading up to yesterday's FOMC announcement. The result is a broad market carrying a good number of trapped longs that has caught fire and is falling back to earth. How far will it fall? The long-term Fibonacci lines will be coming back into play. An undercut of the 161.8 Fibonacci extension level will seal the failed breakout status for the SPX, which will be very discouraging for the longs. In this case, the most likely scenario will be a revisit of the prior lows of the 150% level, which is equal to roughly our prior swing lows down here. So bottom line is that we talked about 2 scenarios going into yesterday's FOMC announcement, and one was, of course, this breakout of the pennant or ascending triangle patterns that we had on the 4 broad market indices, and that if that happened, we could likely very easily move up at least 40 points into the prior resistance area. And you see during the intraday and the initial reaction to the FOMC, and we talked again about the phases of the news coming out, and that the market would likely digest that and have, multiple pulses as the market got the headline number, and then actually the language that goes with the headline number, and then the press announcement, and as a result there was kind of multiple pulses of movement, and the initial move up, which actually made a pretty good run towards this area that we identified as resistance, and then the epic fail all the way back down, and actually closing below its action of the open, and totally reversing all that. Big tall tail there. So not only has this head fake been nullified, but you have a huge tail reversal pattern here. Now the plan B was that if that were to break down, that the revisit of the area of the prior lows would come back into play, and that's probably what we're looking at right now. To continue from the morning reading, it is possible that we're seeing a bear market rally that is doomed to fail. If so, then according to 29 other failed bear market rallies that stocks have suffered since 1928, this would be the fastest and weakest failed rally in history. Stocks are about to enter what is usually a negative time in the year. Watch often mention the historically negative performance in the days following option expiration, particularly in September. And high beta stocks suffered the most, while defensive ones usually fared better. TLT, the bond ETF, which has been positive for the week after September expiry, all 13 years of its experience. So that's a little bit of a seasonality reference there. And while let's go to the right place, there we go, TLT. So after September expiration, this particular ETF has been in existence for 13 years. It has been positive in that period, in the second half of September, all 13 years. Now, generally, the expectation is if bonds, and specifically TLT, if it's positive, that's probably saying that the broad market, like the S&P 500, has been negative. So you put those 2 pieces together, and then this current breakdown in the SPX, and it really does not look to be a very good time to be exposing yourself to new long positions. We're likely to see some sort of retracement in here, and continued volatility carrying over from yesterday. Remember, the Asian markets and the European markets didn't have a chance to respond until last night, and at this point we're down about 16 points in the S&P. and have been down over 20. In fact, we can go ahead and go over to the morning report and cover that. At the time of this cut, we're down about 0.75%. Russell down about 0.25%. The Russell was the strongest one yesterday, which is kind of interesting, and it's generally thought that small caps benefit from low interest rates. They're the ones that are most likely, in general, in a global perspective, to be borrowing money in order to advance their growth phases. Many of these companies are small cap growth type oriented companies. So that's probably why you see the differential both yesterday's action and in the overnight in terms of this announcement. In terms of the NASDAQ, it hit the worst at this point by fractions of a percent. Also down a little over 0.75%, as is the Dow. Crude oil down over 1%. Euro up about 0.25%. Bonds up about 1 and fraction. And then gold up about 1.8%. In terms of overseas action, China up about 0.4%, Hong Kong up about 1/3, Japan down about 2%, Germany down stiff, over 2.25%, closing in on 2.5%. United Kingdom down about 1%. In terms of macroeconomic reports for today, there is nothing in the U.S. schedule that is likely to contribute in any significant way to today's price action. In terms of the market condition, obviously it was pretty interesting to watch yesterday. If you looked at the pattern as it developed, we'll go to the hourly here. Well, let's go to 5 minute. And so you had relatively quiet action with a slight bullish bias going into the announcement. Once you got the announcement, and this is why it's so difficult to trade through these. I mean, you see the initial 5 minutes was from 2008, and this is on the SPX, all the way down to 1988. That's a 20-point range in the first 5 minutes. It then ran all the way up to about 2021. Then in the next 1, 2, 3, 4, 5, 6 candles, fell all the way down to 1986, or some, what is that, 20, 35, about 35 SPX points in a period of about 20 minutes. So not very good response once all the information was digested. Of course, you had the initial response headline number, then people having a chance to read, then you have the press conference, which was happening starting right about here, and you see it kind of runs up during the press conference, but then epic fail from that point and closing back down near the lows of the day. So pretty interesting kind of pattern in all that yesterday. So there's the SPX. We'll take a look at the Dow, which is a cousin. Pretty much the same pattern and a failure of the breakout. And that seems to be getting confirmed today. And one of the things you look at with these candle patterns when you get something like this is, what does the next day confirm? Well, as it stands right now, when the cash opens, we're going to be well down, and that would seem to be at least an early confirmation of this reversal pattern, this reversal candle pattern. Russell again held up the strongest, and we see here, well, it has a tall tail. It still is green, and it is still higher, and it is still above the breakout area. So that one is the outlier at this point. And then NASDAQ, also green, though looks to be, well, let's see, the close here was 83.67, close here 84.96. So this close actually was a slightly higher close, but certainly not a pretty wick up there, big reversal. So while Russell definitely gets the prize for being the most bullish. NASDAQ would come in second, but then the other two, the SPX and the Dow, clearly rejection and reversal type candle patterns coming into today. And then let's see here. We'll go into our regular market condition. Short-term VIX at 22.25. Look at the skew here, still above a 135, which often leads into a multi-standard deviation move. So that is something of a warning sign. IV percentiles 38, 31, 32, 46, all below the means for the last 52 weeks, so that in itself isn't something terribly scary. When it was all said and done yesterday, we didn't have a close-to-close standard deviation move, which is a little surprising, but frankly also not fully representative of what happened yesterday. It's kind of like when you see that college football game and you watch the game and you know that one team was pretty much out of it the entire game, and yet the final score, doesn't really say what really happened. And here the final score is not a standard deviation move yesterday, yet intraday we had quite a bit of movement, especially when you consider that it all happened in the last couple hours of the trading session, and some 35-point range. So a lot of action, and yet ended up pretty much right back where it started from. So that's where you get the zero. So pretty interesting there. When you put it all together, the last 2 weeks now is really coming back into kind of norms in terms of the number of standard deviation moves and so forth. So a lot of the super high volatility has edged off. Some of the fear certainly has come out. Though I would expect that the VIX would move up again today if indeed the current patterns, we're down 18 right now. If the current patterns hold up with the cash open, which is some time away still, if that were to hold up, I imagine the VIX would take a bit of a pop up. In terms of the daily report, we continue to have what we call trend breaking. We still haven't really confirmed and proved otherwise. IBD status remains uptrend under pressure. Accumulation distribution actually got a little bit worse yesterday on the S&P, went to a D+. And NASDAQ still remains an E. GMI index remains a 0 out of 6 with the sell signal, and that author in cash since August the 24th. Primary market condition remains strong bear. Stock charts decision points, we've had some green arrows. Remember, this is a mechanical system. Some green arrows showed up on the short term, but that blog article that went along with that also spoke to the high potential of a false breakout, and that certainly seems to be happened so far, with more information looking to come in. Intermediate term market posture still weakly bullish. You continue to see these intermediate term market postures just ever so slowly pull up, and indeed the Dow now has gone into just outright bullish at a 51, NASDAQ 63.7. So that certainly is some help for the bulls case. S&P's at a 44.1, still weekly bullish, as is the NASDAQ, the Russell at a 45.4. Overall, when you put all this stuff together, we take the investor posture and we still come away with a bearish bias across all three time frames. As the consensus of these systems in terms of the intermediate term time frame, and you put that together with the first, and our hedge warning status remains a hedge level 2, threshold level 2, which is our red light. Increased risk conditions are still present in the market, and a number of things that are playing into that. And in terms of the volatility-based metrics, market in decline, sharp increase warning are still firing off. They fired again yesterday. We still have a VIX over an 18. Distribution day count actually went up yesterday. It's now at a 2 since the reset on those counts started. And then you have a skew still up above 135, calling for that potential for a multi-standard deviation move being enhanced. You are with yesterday's intraday action, you actually on the New York Stock Exchange put in a pretty significant number of new highs for the month at 262 and well above the new lows. But obviously we've taken a look at that intraday action, and we know that this was a failed move by the bulls on at least that time frame. Intermarket risk aversion indicators still are all risk on though, so again we continue to get these kind of mixed signals, and many times when you see kind of chop action, failed breakouts and the like, these are the kinds of things that happen. You get some of these what seems to be all bull all the time kind of signals, and then at the same time you get things like market in decline and sharp increase warning. That's why we use a variety of metrics to be able to get a feel for what's happening in the market across multiple time frames, short, intermediate, long term, across whether it be market timing type systems, whether it be volatility based systems. They all give us a different kind of cut on the information in which to kind of give us a more complete picture as to what's really going on. In terms of our special opinions, we yesterday basically said, don't do anything in front of that Fed announcement. Wait for that to settle out and see what you're dealing with. And this morning likely will be quite an interesting morning. We'll see if this weakness continues and whether you start to find some support and whether that support holds. So don't jump, I would suggest, on the first mark of a bottom, but look for a higher low. Okay, so you have a reversal pattern. You have a higher high, at least in the short-term time frame, come into play, followed by a higher low, and start to see that there's actually some traction. If you're very aggressive, you might consider whether you want to put on either legging into some puts on positions that you're willing to own and the size that you're willing to own, or perhaps legging in to a covered call. Even better, leg in through put selling on something that you're willing to own, and then if it gets assigned to you, that you then work it as a covered call. Those are usually the first two steps to step in front of what looks to be weakness and to start accumulating positions. If indeed our second theory comes into play, we could drop another 100 SPX points. So may want to see if indeed we start to see the bulls come in and then take it back up into this range here. If we get back up above this pattern and we start to have a couple days today and into Monday and start to move back into this pattern, then you could start to feel a little more confidence in putting on some puts, putting on maybe some covered calls, and start to accumulate some small positions. But if you're not seeing this immediate rejection of the bears and the bulls taking this back into this area here, you're very, very likely to start to see this pattern really deteriorate, and you could have a couple or several negative days that ultimately in the next time phase could take us back down here to this 1866 area. So if that's going to be the case, if you start to see those kinds of patterns develop, you really want to wait to initiate your puts and your covered calls and other bullish strategies. So we're really we went into yesterday at an inflection point. We're really kind of in a balanced act right now, with the first bias being bearish until proven otherwise. And once you start to see the bulls come in, you'll want to see some confirmation patterns probably and feel like you're up into this zone here above about we'll call it on the SPX above, say about 2,000, get above the round number. You start to see a close above 2,000 in the SPX. You might want to start nibbling at putting on some bullish positions. But until you see that close above 2,000, it really is quite perilous to be able to be initiating positions, because you're basically risking might be 100 points on the SPX versus an opportunity that in the short term would seem to be potentially about 40 points to the upside. Those are not the kind of pot odds that you are looking forward to with your trading capital. So kind of a tricky time right now. In terms of sector specific, you did have, in general, mostly green action across most of the sectors, but in the total picture here, and you notice financials down, they were, of course, one of the losers of not having interest rates go up yesterday. And in general, very difficult for a broad market to go up when the financials are not participating in a big way. They are a very important, very heavy part of the S&P 500, and not all these sectors are the same. Utilities, for example, represents less than 5% of the capital of the sector. So just because you have, say 9 or 10 sectors here, depending on how you count those things, they're not all equal. Financials far more important than utilities in some of these other sectors, and financials certainly taking a hit with that interest rate decision. You did have utilities did well, healthcare did well with yesterday's action. Both of these heavily, usually debt-laden organizations and or sectors. So with that interest rate decision, that helped them. But you see on the flip side, others who are on the wrong side of the interest rate decision down here at the bottom. So that's more than enough for today. We had kind of a long session this morning, but some very important action in our trading market. If you find what you're getting here is helpful to your trading, we greatly appreciate you retweeting us to your Twitter followers, to your StockTwit followers. Like us on YouTube and the various other social media platforms. Obviously, YouTube can also allow you to subscribe and get immediate notice when we post. Email support at falconglobaltraders.com. More information is available at this website. Disclaimers, as always, hit the pause button if you need more time to review this. And we'll see you back here Monday morning before the market open with the market preview from Falcon Global. Good trading.